Question number 11. At the beginning of the current year, Taunton Company's total assets were $262,000 and its total liabilities were $182,000. Let's see, we're looking for the debt ratio, which is total liabilities to total assets, and we're looking at this debt ratio at the end of the current year. Well, let's see, let's set things up here. The beginning of the year, they told us, like I said, that assets are 262, liabilities are 182, and we could compute owner's equity of $80,000 by just taking the difference between assets and liabilities. So we have beginning owner's equity, but that doesn't help us any to this thing we're looking for, which is debt ratio at the end of the current year. So what else we have? During the year, the company reported revenues of 107. So that will increase owner's equity during the year. Total expenses of $83,000, that will decrease owner's equity, and withdrawals by the owner of $6,400. Okay, there were no other changes in owner's capital during the year, and total assets at the end of the year were $274. So let's put that in. We can take the owner's equity at the beginning of the year, add revenues, subtract out expenses during the year, and withdrawals during the year, and we get an ending owner's equity of $97,600. If we are given that, let's see here, that total assets at the end of the year were $274, we can plug that in. So now we can find, if we know assets at the end of the year and owner's equity at the end of the year, we can find liabilities at the end of the year, $176,400. And that's what we need. We need total liabilities at the end of the year and total assets at the end of the year to get this debt ratio. So let's do it. So 176.4 divided by 274 is going to give us 0.64. That's our debt ratio. And that's 0.64 to 1. And that means it looks like we've got 64 cents of debt for every dollar we have in assets. And higher would be something that the bank would not like. They would like this to be lower so that they could have less risk on their part. Number 12. We have assets of company 1, liabilities, average assets, net income, and they want to know the debt ratio to 2 places, and they also want to know return on assets to 3 places. So debt ratio will be $9,000 worth of liabilities to 101 in assets, gives us to 3 places. This comes out to be 0.09 and for 2 places. And return on assets will be net income divided by average assets, which would be 21,000 from up here, divided by 110.5, which is average assets. And when you run all that through your calculator, for 3 places, there's 3 places, but that's really, since that's a 0, it's 0.19. Number 13, at the end of the current year, Norman Company reported total liabilities of $400,000 and total equity of $200,000. The company's debt ratio on the last year end was what? Well, last year end, let's see, we've got assets, which we don't know. We know liabilities and owner's equity. We can figure out assets, or it would be $600,000. Just these two added together gives us $600,000 in assets. And the debt ratio would be the $400,000 divided by $600,000, which is 66.7%. Number 14, what are the totals for the trial balance? Well, we've got to figure out what is the normal balance for each of these pieces and put them on either the debit side or the credit side, and then add them up to see what the normal balance, to see what the trial balance total would be. So we got cash as a debit, accounts receivable is a debit, accounts payable is a credit, fees earned is a credit, and rent expense is a debit, insurance expense is a debit, supplies are a debit, capital is a credit, and withdrawals are a debit. And you can add up this side, and the debit side should equal the credit side, so let's see if it does. Both sides equal the same, which is 127.2, and that's the end of that one. Number 15. An accountant has debited an account for $4,100 and credited a liability account for $2,000. Which of the following would be an incorrect way to complete the recording of this transaction? Well, here's what you need to know about this. If you have a debit for $4,100 and a credit for $2,000, what you need to balance this transaction is you need credits, and you need $2,100 worth of credits, because the $2,000 here that's a credit plus the $2,100 that you need will make the credit side equal $4,100 worth of credits, and you'll have $4,100 worth of debits on the debit side. So that's what you need to keep in mind on this kind of transaction. You need, again, if you've got $4,100 worth of debits and you got $2,000 worth of credits, you need $2,100 to make this thing balance. So that's all I'm going to say about that. Number 16. A $20 credit to sales was posted as a $200 credit. By what amount is sales in error? Well, here's our accounting equation. And the correct amount was $20 worth of credits to sales, but we did this instead. We posted a $200 credit to sales. So therefore, if the correct debit was, let's say it was a cash sale, we debit cash for $20 and we credit sales for $20, but instead we credit it for $200, then that's going to mean we're going to have a sales error of, looks like $180. This is what we should have done. We should have debited cash and credited sales for $20. Instead, we debited cash for $20 and credited sales for $200. Therefore, sales are overstated by $180. Number 17. Let's see here. I'm going to skip number 17, and we'll maybe talk about that in class. Let's go on through. You can stop the video and you can see that. Let's see. I guess we'll talk about it just a little bit. A trial balance taken at the end of the year showed total credits exceeding total debits by $6,400. So the credit side's higher. It should be the same, but the credit side's higher by $6,480. This discrepancy could have been caused by what? Well, you're supposed to figure out how you would get a situation where your trial balance is out of balance by $6,480. So let's see what we got here. An error in the general journal where $6,480 increase in accounts receivable was recorded as an increase in cash. Well, you're still going to be in balance even though you hit the wrong account. You had equal debits and credits, so you just put it in the wrong account. You put it in the cash account. It should have been accounts receivable, so that will still mean equal debits and credits, so that's not the problem. B, the balance of $64,800 in accounts payable being entered in the trial balance as $720. Well, that difference is going to be a $64,080 difference, so this is not the answer either, because all we're off is $6,480, not $64,080. C, a net income of $6,480. Well, net income, if it's right, which we have no reason to believe it's not right, still would give you equal debits and equal credits. So that has nothing to do with why we're out of balance by $6,480. And then in D, an error in the general journal where a $6,480 increase in accounts payable was recorded as a decrease. If that was the case, if you recorded it to the wrong side, your debits will exceed your credits by twice that, because you put it on the wrong side, of $12,960. So that's not the answer. That's not the why we're out at $6,480. Number E, this is the right answer. The balance of $7,200 in the office equipment account was entered in the trial balance as $720. We should have put $7,200. Instead, we left off a zero and put $720. That difference will give us credits that will exceed debits by $6,480, and this is the only answer that could be right. From all these above here, that's the only answer that is right. Number 18. The company purchased $7,000 of equipment on account. The new accountant incorrectly recorded the above transaction by debiting cash and crediting sales. Now, we should have debited equipment and credited accounts payable because we bought some equipment on account. That is, we charged it or whatever. So we should have increased an asset and increased a liability. Instead, here's what we did. Instead, we increased an asset by $7,000, which was cash, and also increased a revenue account by $7,000. That's what we did. So if this is what we actually did, this in red, and we should have done what was in green, how will our assets, liabilities, owner's equity, revenue and expenses, and net income all be affected? Okay, so assets looks like you should have increased assets by 7, and you did. So assets will be not affected. Liabilities, you should have increased liabilities by 7,000. Instead, you didn't do anything to liabilities. So it looks like liabilities will be understated by 7,000. Owner's equity should have done nothing. You should have made no change to owner's equity. Instead, you increased owner's equity by 7,000. So it'll be overstated by 7,000. Revenues, you should have done nothing to revenues. Instead, you increased revenues by 7,000. So revenues, by the way, will be overstated. Expenses, you should have done nothing to expenses, and you did nothing to expenses, so expenses will be not affected. Net income will be raised by 7,000, and you should have done nothing there, so net income will be overstated by 7,000. Very important problem. This is a very important problem that will lead to your understanding of how adjusting entries work. Number 19. We have 9 transactions, and we want to know what is the ending cash balance. So let's go through here and see which one of these things affect cash and by how much. The first one, invested $25,000 cash. That increases cash by $25,000. We gave $100,000 to the business. That has no effect on cash. We paid $2,000 cash monthly rent. That decreases cash by $2,000. We got $16,000 for repair revenue. That should increase that by $16,000. We paid $6,200 for salaries. That should decrease it by cash by $6,200. Provided services on account by $3,000. That had no effect on cash. Paid $500 for monthly utilities. That should decrease cash by $500. We got $3,100 in advance of earning it, so that will increase cash by $3,100. And we withdrew $5,000 from the business for personal reasons. That will reduce cash by $5,000. Combine all these amounts, and the cash balance should be $30,400.